Hey, welcome to the second video on shares. The first one is about why a company might offer shares in its business. And this one is going to talk about how do you know what your shares are worth and can you make money by selling them? Should you sell them? And then we're going to look at what's involved in selling them. So let's have a look first of all at what are the shares worth. Well, that could be this little graph up here. We hope the shares will be growing like that column graph there. We hope that's going to happen. And we want to know, have we made any money? And is it a good time to sell the shares if we're in for a shorter rather than a long-term investment? And a couple of little pictures here of a couple of companies whom we will call blue chip shares. They are pretty reliable companies and they're not likely to lose money and reduce their share price. So let's go down now and have a look at trying to answer some of these questions. So coming down the page now, we'll have a look at a sheet that's released by the stock exchange, and it looks like this. And this is probably a bit hard to read here, so you can go on their website, the stock exchange, and you have sheets here on each of the companies, 52-week high or low, the latest days trading high and low. That's the stock exchange code for the company, the name of the company, and here we're talking about whether it went up or down during the day, and the buy and sell prices there, the latest buy offer or sell offer or bid for the shares. Okay, and then we've got a little section here which talks about dividends. That's the return on the shares. If the company has made a profit, they decide to share some of that overall profit with the shareholders, and they create a dividend per share. And something over here called the PE ratio. So we're going to talk about how you might use this data to determine whether your shares are doing well and exactly what's going on with them. Okay, so come down a bit and let's have a look at that ratio. So this is a ratio that enables you to, let's just come back up here a bit, to work out the price of the share compared to what it's returning. Okay, so the share price divided by the earnings per share, which is of course the dividend. And it might be something like 17 cents per share or something like that. So we're going to have the share price, maybe $4.50 a share, divided by the return per share. What's that likely to do? We're going to, for you, get what pictures it's going to give you. We'll talk about that in a minute. Let's talk about the earnings per share and how you'll work that out. So the company directors determine how much of their overall profit for the year they are prepared to share with their ordinary shareholders. So you divide how much profit they are going to distribute. Wouldn't be the whole profit, of course, because they might want to keep some for further expansion. And then you divide by the number of shares. So you get an amount. It might come down to something 17 cents per share. It'll depend on the overall profit and how many, maybe thousands or millions of shares that they're going to split it over. So that's a calculation they have to do. Now, the PE ratio is trying to compare this return, or the price per share, price over earnings, or the dividend per share. So if the share price was $4.50, that's 450 cents over 17 cents a share. So that ratio, well, you might not have any ratio at all for a company because it hasn't had any earnings yet. The company might be in the ratio between 0 and 10. So in other words, this ratio over here is about 34, I think, something like that. But if the ratio was lower, what does it mean? Well, it means its share price is quite low compared to the return. So the company might be undervalued. So you might be expecting, if those earnings keep up, you might expect the value of that share to go up. Or perhaps the shares are predicted to decline and the share price, the earnings are predicted to decline because they're going to go down and you'll get a smaller ratio. Now, between 10 and 20, that's usually the ratio that companies that are doing quite well and have a reasonable share price will return. So it's considered to be, well, about right, and you wouldn't expect much movement, probably, in the earnings or the share price. 20 to 30 suggests that the company's price of shares over here again, giving a big ratio, it suggests that maybe their share price is a bit high compared to what they're earning. So maybe that price is, the company's overvalued, and maybe you might expect the share price to drop. Or maybe they're expecting the earnings to rise, and therefore that's why you're going to get that ratio. Okay, so when it's deviating from 10 to 20, that reasonable range there, then you might start to look at it and say what's going on, and is one of them going to change? The earnings going to change, or maybe the share price might go up? And 30 plus, the company's either exceptionally good prospects, okay, or it's the subject of much positive speculation. So it's very, very high. We're expecting that share price to jump up because it's got good prospects. All right, so it gets a bit complicated. Really, a beginner needs to get some advice from a share counsellor or a share investment counsellor and or advisor. Okay, let's go down and have a look at what we're going to do now. We're going to do some calculations as if we're running a business. And here's our business. HWB Industries report a net profit of 36.5 million. That's how much they're going to share with ordinary shareholders. It has 73 million ordinary shares on issue. Okay, so we better work it. We want the PE ratio, the price per earnings. So let's work out the earnings. That's the net profit they're going to share with us, divided by a number of shares. So it's 36 million, or a lot of zeros there, mate. Wish that was my bank balance. And then divided by 73 million shareholders. Only comes down, the big numbers only comes down to 50 cents a share. So what is the price earnings ratio? The share price is $8 and they're returning 50 cents a share. We'll just make sure the units are the same here. So one is in cents and the other one is in dollars. So it's 8 over $0.5, or it's a ratio of 16. Okay. Share price moves up, okay, because they've got a reasonable dividend there, and it moves up due to positive news. So it's gone to $12, but the dividend that was already just paid is 0.5 or 50 cents, so it's got a ratio of 24. The ratios increase. Now, the company may now have been overvalued. You might say, well, if I pay $12, that's a bit higher than what we would expect. And the ratio will naturally decrease if earnings improve in the next period. Okay, so the earnings, this may go up now because the share price has jumped because somebody considers this company's got good prospects. So they're expecting a higher dividend next year, and the ratio will naturally come down and balance. So the last one is the company is involved in a scandal and the share price drops to $5. What's the effect? So the share price has dropped to $5. Remember, the dividend last paid was still the same, so it's 10. Now, I would say the company would be undervalued. It's dropped because of a scandal, but it will recover and regain, one would imagine. Okay, so they are the things we need to start to understand before investing in shares. Come down and I'll give you some little examples here. This is from Hayes and Harris' book on General Maths for Year 11. So pause the presentation here and have a go at those questions. And at any time when you've done a question, you can fast forward the video because we've got the answers underneath. Okay. So let's go to the next few, 4, 5, 6, 7 and 8. Okay, so remember, pause it, try to set it out as with example, so you can toggle back and have a look at the example or look at it in the textbook, and then I'll go on and show you the answers now. Okay, here we are. So there are answers for that exercise 4B. All right, so I hope you're getting some idea of what's going on there with that P over E ratio, price to earnings. Gives you some idea of the performance of the business relative to their share price. All right, come down and let's look at what you might want to do if you want to get into the share market, and that you want to buy some shares now. Okay, the person buying shares has to pay some fees. First of all, the consideration is the cost of the shares. What is being considered here? What is the deal being considered? I want 1,000 shares, please, and at $4.50 each. So what are we going to consider? 1,000 lots of $4.50, which would be $4,500. So that's my consideration. That's called the consideration. So I'm prepared to pay that. Now, I will get a broker, a stockbroker, to handle the deal for me. It must be a registered person who's registered with the stock exchange. And the brokerage is their fee. Fee paid to the stockbroker, to the broker. Okay, and that can be done in two ways. One way is a percentage of the deal, of the consideration, and the second way is a flat rate. And some people do it both ways. So in other words, there's a flat rate if the deal is under $5,000, and if it's over that, there's a different rate, and so on. So there are various ways of doing that. The GST is the government services tax, okay? So this is on any work that's done. There's a goods and services tax, GST, and that is 10% in Australia at the moment. So that is 10% on the deal. So you actually have to have a bit of money apart from the general consideration, what you're considering buying. You've got these two other things. You've got to pay the taxes to the government. You have to pay the person to work on your behalf and make sure the deal goes through and money is received. The money is received by the other person who get the shares. So let's look at a calculation like that. Calculate cost of buying 1,500 Telstra shares at $5.40 each with a brokerage of 2%. So the consideration is 1,500 times $5.40 plus 2% of that value, based on that value. GST is 10% only of this fee here, because that's the services fee. It's a GST, a goods and services tax. So it's 10% of $162 only. So the GST is only on this. It's a goods and services tax. That's what that stands for, goods and services tax. So overall, you pay that. Thank goodness you only have to pay 10% of the whole lot. 10% of 8,100 is a lot bigger number. So it's only on the services there. Okay, get the idea? Okay, let's do another one. Calculate the cost of buying 500 Qantas shares at $4.80 each, brokerage $30 flat fee. So the consideration is 500 times $4.80, flat fee, and then 10% of the goods and services, 10% GST on this one is $3. It's not a bad idea to set it out like this, so you know what you're doing. So the total here is that. What's the difference between those two problems? Simply the different way the brokerage fee is calculated. The first one was a percentage, the second one is a flat fee. Are you ready? I think it's time for you to have a go. So come down here and we'll have a look at your problems. Okay, so I think there's 7 questions here. And what I want you to do is, as you did before, pause the presentation and work out consideration, brokerage fee, and GST. And the answers are coming up down below. Once you've done a problem, don't do them all, do a problem, get an answer, fast forward the video and check the answer so you're not perpetuating an error. Let's go and look at the answers now. There they are. All right, so that's all I want to share with you there for the second video there as we build up. What we're going to do in the next presentation is have a look at selling shares, what's involved there, because you may want to sell if you've looked at the sheet of from the stock exchange and you like the way the shares are travelling and you think you'd like to sell yours and take your money. All right, well, until then, it's cheers for now.